welcome everyone. Welcome tonight or this evening, depending on where you are in time in the world. We're going to have an exciting discussion today on insurtech, trends in AI, and automation. And joining with me are three panelists, each with unique backgrounds, different roles, working in different parts of insurtech. I'm very much excited and looking forward to this chat. As a moderator, obviously, I've had some background in insurtech, previously leading product and product design for Haven Life, direct-to-consumer life insurance company. So I'm very excited to hear what the audience members or the panelists have to say. And I encourage our audience members, if you have questions along the way, please do engage. There is a chat window in your Zoom. Ask those questions along the way. I will be monitoring those and looking for those. So you can think of this as almost a Reddit. Ask them anything you like. So hit them with questions. With that, I'm going to let the panelists themselves introduce each of themselves. And maybe we can start with Nancy.
Great. Thanks, Sean. Hello, everyone. Thank you to MIT Enterprise for having me. It's actually a great pleasure to be here with a great panel of speakers. I'm Nancy, and I work at MetLife. Currently, I'm the Chief of Staff in the Global Audit function, leading our strategic efforts in digital transformation. And what that really includes is actually building advanced analytics and automation to help auditors audit risk better and faster across the company. And I'm based in New York.
Thanks, Nancy. John, how about we popcorn it over to you?
Yeah, sure. Hey, thanks. It's great to be on. Thanks for having me. My name is John Henry. I'm co-founder and co-CEO at Loop. At Loop, we're building the biggest hearted insurance company in the world. We're starting in private passenger auto. We are eliminating a lot of the demographic factors that go into your pricing, including credit, which is a very, very hot topic, education, occupation. We don't believe those things matter. So instead, we have developed an actuarial model that effectively prices you based on where you drive and how you drive. I would say that the telematics, since I can go a bit deeper with this audience, the telematics piece is not particularly novel, but what is novel to us is we compile multi-layers of data, including roadway infrastructure, 100 million crash records that are publicly reported and automatically ingested into our database, traffic volume, and weather data, and effectively develop a really deep and thorough understanding of the quantification of risk of the roads. Once our customers are insured by Loop, we're able to intersect where they drive against our understanding of the roads, and the output is a really fair, inclusive, transparent price for customers. So that's a little bit about Loop and a little bit about our mission, I guess.
Thanks, Ron. And obviously, last but not least, Alan.
Hey, everybody. I'm Alan Anders, head of data strategy at Carpenter. We are the reinsurance arm within Marsh & McLennan. I think of it's a reinsurance brokerage. You can think of that as like meta insurance. We do everything between property, auto, aviation, all the way to a piano player's hands. Reinsurance is a way of transferring risk between insurance companies to reinsurers. To protect against volatility, to ensure growth, and allocate more capital. It's a really exciting and actually new business for me. I come from the startup technology world and trying to sort of move forward our data engineering, data science, and digital practice within the firm.
Thanks.
Wow, what a panel.
Yeah.
Great job to
got folks here who cover carriers, reinsurers, and we got actually on building direct to consumers as products in there. So I think we've got a great panelist along the way. I'll kick us off maybe here just obviously the discussion is AI and automation within insurtech. AI can be a lot of different things. Oftentimes people might think about just obviously self-driving cars, but maybe I'll start off with Nancy. What does that mean actually to you within maybe your purview?
Yeah, I mean, that's a great question, Shah. I think, AI in the popular press, like to your point, driverless cars, robotics versus AI insurance. I think there are definitely similarities in a sense where, at the end of the day, AI is all about improving that customer experience. And I think I see both, together trying to solve that in the same way. I think the difference is that, I think in the popular press, customers do see AI, in a much more relatable way. They see, how it's actually applied every day versus insurance, which I think if you think about that, it's actually quite a taboo topic, right? Especially life insurance. And it's not something the customers really feel and experience every single day. But I think the pandemic really helped put a spotlight more recently on the importance of health and life insurance. And when you think about the power and how that can actually bring benefits to organizations like a carrier to make sure they are much more knowledgeable in understanding the customer and what's the best insurance for them, I think that's actually quite powerful.
I'm going to maybe add on to kind of John, you talk a little bit about obviously using data here to giving a fair price. How do you think about it differently, or how do you think about it?
Yeah, I think Nancy, you had some great points, and should build on that. At Loop, we view, well, AI in our, I guess from the way we operationalize it, is ingesting raw data sources and developing predictive models to drive better outcomes. And from our understanding, at least my understanding of the field, there are two main applications of AI. One is to drive efficiency, and the other for optimization. And typically, we've seen, and pardon, just to take a quick step back, just for my background, I realized I didn't share it. So I'm pretty much a lifelong entrepreneur. I've pretty much done nothing but I was a doorman, and then I dropped out, or like left school early and left my job to start my first business, built commercial logistics company, and then an incubator. And then most recently was a co-founder of a venture fund called Harlem Capital, where we invest in women and minorities and so on. And so the really unique thing that being a VC allows is a really macro view. Seeing 1,000 deals a year allows you to develop a pretty sound perspective on where industries sit at the moment. And from what we were seeing was a lot of the AI plays were driving efficiencies, and a lot of them were situated in B2B environments where, they're effectively AI tools that can increase, companies' efficiencies across their operation. Interestingly, within insurance specifically, what we've noticed is that the rate at which larger carriers adopt new technology is much slower for a number of reasons. One, oftentimes the products are very segmented, and so there's a reluctance to pull the trigger on a particular product, and then you have a really fragmented suite of solutions that you have to toggle between, and that's a nightmare. But the other, at least from property and casualty side, and specifically within private passenger auto, is that it's a regulated field. And so we had this grand ambition to, at first we developed a B2B tool actually to help carriers underwrite more efficiently. But what we didn't know, or what we didn't foresee, was the fact that having these carriers go back to state regulators on a state-by-state basis for books of business that are live and doing just fine, especially because they're making a hefty amount of profits from invested premiums, was a gargantuan lift. And then that's when I took a step back and I realized that a lot of the unicorns that exist in financial services, from insurance to banking, and really from life to health and home and auto, are consumer fintech plays. Mm-hmm. They vertically integrate their technology because they realize, rather than face, the middle management hell and die in politics, and then you get someone on the cusp of buying and then they leave, you feel a lot more in control of your fate when you're able to directly express the technology to the market. It's more difficult, it's more capital intensive, it's a daunting task, but ultimately at Loop, that's a little bit about my perspective on what AI is, but also how it's operationalized in the actual environment that we're in today, if you want to build something. And I would be curious for Alan and Nancy's take, actually, and play a little bit of a devil's advocate and make a case for why your organizations are adopting, technology, because I do think very highly of Matt and Guy Carpenter.
Alan, I think this is a perfect where he's like teasing you in and be like, "Oh, are you going to really support my point of view?"
Well, I love how John brought in the regulatory aspect, because that is big. When I came to this industry, immediately I'm thinking, we're going to get into the risk aspect. We're going to do all of the machine learning to for underwriting and pricing, but there's enormous complexity with regulation. I mean, just look at some, like, I don't know if people are familiar on this call with Oscar, but they were promising the world in medical insurance, and they brought in some of the most talented folk. But it's just a very, very big challenge for that company to grow on a state by state basis. I think depending on where you sit in the world, there's all sorts of challenges. If you're digital first, like the Lemonade, the Hippos and Slices of the world, you're in a place where you start collecting data. Or if you're at the classical insurers, you're maybe just, and I'm not kidding, just discovering what the cloud is, right? And just realizing, oh my gosh, we have to collect the data to build the machine learning algorithms that we want, right? And it's ongoing challenge. And I can see there's so much to do here. I think the actuarial profession is growing into what I call like risk scientists that, talk about, how do you bring in the open source technologies, the machine learning, and sort of the art and history in the actuarial practice, which is very traditional, going back many, many, many years. And then where you can insert AI and machine learning, right? This is like efficiency, has how John mentioned, but it's, marketing and sales, underwriting and pricing, and just, it's all over the organization. You have to be a little imaginative on what you want to do there. But it's a very big conversation, and it's exciting how we want to talk about it.
Nancy, anything to add? I mean, Alan did kind of mention this case. Well, maybe John's got a little bit of a leg up being digital first. Sounds like MetLife is just discovering the internet in this case as the cloud. How do you think about it?
Yeah, I would wholeheartedly agree. I think companies that are born digital, obviously it's right out of the gate, it's just easier because you're going, you're starting the business with understanding what your business model is already, right? Mm-hmm. And therefore you already know what data is needed. I think for MetLife, we are in a carrier for over 150 years. And when you think about the data architecture and the system architecture, it's pretty much a spider cobweb there, right? And to unwrangle that and really try to focus, where do I start? That's a really big question to answer. And I think we've actually had good success to date in AI, and I'll be happy to share some of the examples as we continue the conversation. But it's hard, and I think everyone wants to do AI, but the question is how. IBM actually has a really, really nice AI framework, which they call this kind of, you got to climb the ladder, right? You kind of take those steps in the rung of the ladder. And that first step in the ladder is really collecting the data, as what, Alan mentioned. It's just so important. It sounds so basic, but it's so hard to do. And it's a struggle for our company as well.
Yeah, and I just want to add in there because I think it's easy to discount the larger organizations and say, okay, they're not digital first. The systems architectures are indeed archaic. But what they do have is the scale and the distribution and the brand equity and the capital, right? So now, can you, as a startup, Loop is fresh, brand new, a baby. We raised $3.25 million. We're not even in the market yet. We're going live in June. We actually just filed our product with the Texas Department of Insurance and hope to be approved and so on. So we'll have to fight that fight in, but we'll go live and then we'll start writing premium. And if we're lucky, we'll do $5 million in year one. Mm-hmm, mm-hmm. That's but a rounding error on the balance sheet of MetLife, of Progressive, of all these companies. Now, Progressive is a unique beast because I do think that they're, obviously like a super tech forward large carrier. But for the large organizations, they have such a unique opportunity because, Alan, to your point, data collection, first step, you can just say, okay, flip a switch, relatively speaking, and implement processes where in your quoting process and so on, you're collecting data and you will be at scale a lot faster than a startup. So it's like, can you grow we think about, can we grow faster than the large incumbents can adopt and pivot? And, it's a fascinating debate and a push and a pull, but I did just want to give the large carriers some incredible credit because, for the things that they haven't gotten good at, there's a reason that they've been around for 150 years. There's a lot of operational capacity, a lot of core competencies, and really, really deep knowledge on a number of facets within the insurance business.
Something I want to say about John's comments, because I come from the startup world, and I had a really good time. I loved it, but it's a very different situation in the startup world. I feel like you can attract, a lot of the sexy, strong, amazing tech talent, right? Like like a promise of this future. But time and time again with me, I actually found it difficult to attract the business talent, the sales and the marketing teams that you need to scale out the incredible technology. And a lot of the more like classical firms, and I'm going to maybe say something controversial here. I think they're actually a bit hollowed out with the tech, in those companies. And it's actually very easy to step in and innovate as a technologist. And you have an incredible sales team, but it's the challenge is actually just kind of weaving that story together, like getting those, the brokers or, your sales and marketing groups and the business folk to, play nicely with the new tech talent. It's like, it's really interesting. It's like, are you barbarians like outside the gates or like inside the gates, right? Where are you disrupting, on the inside or the outside? And they're both really hard, either way, however you go about it.
Maybe here we can dive just a little bit more as I love this conversation where it's going. Nancy, you hinted upon a little bit earlier, there are some successes here to date, right? And kind of Alan's almost saying that, hey, if there's successes here, it's actually fairly easy to apply technology perhaps to make that successful. You got the scale. Anything you can share with some of us about what those successes look like?
Yeah, definitely. I mean, so I think AI is a reality in this industry. I think for MetLife, we've gotten, a lot of good success stories in this space. I think one of the example, which, is public news, a few years ago, where in our call center operation space, we've actually, used a vendor to help us design this AI platform that can, through speech, steer our call center representatives as they're talking to the customer and, pacing themselves, like talk slower, right? Be more empathetic and show more emotions, in your conversation. So, that's a really good example in how, speech, technology and applying AI and using, startup companies and actually helping a carrier like us think about, this type of capability in changing and improving customer service interaction at a call center, which traditionally, as you know, people dread calling someone, right? And like, I need help with my policy. But this really should help streamline and improve and, a much more positive experience so that it's, again, more empathetic, more in tune, right? And making sure the call center representative is kind of in the moment, in the conversation with the customer, and really giving them, the best service possible through, some of the nudge from this type of technology. So that's one example, that I can share. We've actually seen, a really good improvement score in terms of performance in customer service quality, and we've rolled it out in the U.S. So that's just really a very good example on how even applying in a traditional area like that can really see a lot of benefits.
Got it. And Alan, maybe building upon that, as you kind of enter the industry, where you said a bit earlier, there's many maybe different areas you can apply this, potentially this technology, right? Where have you seen, or even maybe at Carpenter, where today successes or early stories where you guys are actually using this?
Oh, that's really interesting. So at the reinsurance brokerage, we have a very different story. We're actually just on the data capture and data normalization phase. I mean, if you imagine if you're running, you're looking at 30 different lines and data is coming in from all of the, if you look at AIG, they have a challenge just wrangling their own data because they've, acquired so many insurance companies over the years. And then so as a consequence, we get really bad data from them in the reinsurance process. So we're trying to sort of bring data standards. We actually have machine learning to help standardize data, which is like
cleanse data, standardize data, all of that task.
Exactly. So like, automated data preparation. So if you look at tools in that space, like Trifacta, Paxata, which was recently, bought by DataRobot, there are these sort of citizen data prep tools. And we're looking at bringing those on along with the automation so that we can do a lot of cool work. But I mean, in forward looking, the two things that I'm very thoughtful about is the data capture on the loss experience. And I think the carriers, traditional carriers have a lot, like a big advantage there from the new entrants. I mean, if you think about, if you want to do machine learning on risk, how long does a new digital player have to wait until they accumulate enough loss experience before they can sort of bring machine learning to sort of estimate and do sort of predictive pricing there? It's a long time. But we do a lot of thought about collecting data at scale in terms of risk characteristics. And I am very concerned about the future Googles, Amazons, and Teslas of the world getting into insurance when they have all of this data on consumers, automobiles, homes, and properties and businesses. So that's the sort of top of mind, and we're trying to collect that data in a world where we can sort of help the carriers compete in the future. Is one of the things that we're thinking about.
Got it. I mean,
I think on that point, just while it's fresh, I have a hypothesis around big tech entering insurance. I just believe that they won't, because
at all. Like they'll work with an existing carrier or reinsurer, maybe even you as an example, to offer these kind of services and products.
Yeah, I just believe it introduces too much scrutiny, and specifically regulatory scrutiny, into their already increasingly sticky situation with antitrust and growing antitrust sentiment. But I do agree, if there is any type of player that can very efficiently, mobilize at scale and give large carriers a true run for their money, it would be big tech. But I think that is sufficient reason to keep it kind of out of their roadmap. There's so many other spaces for them to really play and put their data to work. So I just wanted to jump in there, but Shaw.
No, that was great. I'm going to build just a little bit on that. Alan, Nancy, thoughts on that? You also say, hey, if they got so many areas they can play, we're talking about, I think Texas and a bunch of the states filed antitrust. Obviously, the case of them, they got enough things to worry about. Yes, they could have data, but, not anytime soon on my plate. I'm curious what either of you think.
Ooh, that's a challenging one. So, I mean, I can tell you, we've lost some actuaries to some of these big tech firms. So they have ambitions. Whether I agree with you that it's going to be an interesting journey from a regulatory standpoint. They do have the lawyers, and they do have that legal talent to push things through. And but I don't know. One of the things I think about is the unfair advantage, right? I mean, if you are Google and you understand people's search history, you know how risk averse they might be, right? You might know a lot of their behavior and how they live. And, and your behavior affects how you drive, how you take care of your home, how you take care of yourself. And my gosh, the unfair advantage of some of these players entering the market, if they can use that data. And so I think a bit of a question is how much burden is it for them to enter the market, and how long before regulation comes around saying, well, you can't use that data, or you have to allow other carriers to use the data to play competitively? That's something that I'm thinking a lot about.
Nancy, any thoughts on there yourself?
I think the competition is real. I mean, if any carrier says, I'm not worried, I feel like we just need to make sure that, big carriers like us need to understand the business landscape. And I think for us, it's all about making sure we have a sense of purpose, right? How do we see the next 50 to 100 years and kind of surviving through and staying in the industry and being strong at that? In the end, it's all about building customer loyalty. And I think that's a big part of our purpose, to make sure, big carrier like us continue to keep that promise and continue to follow through on that, right, globally. So I think that really matters. I mean, while the competition is real, but if you have really a strong customer base, which I believe we do, it's hard, right, to kind of just, let someone kick you out, immediately. So that history and the legacy for us is strong. And I think having that clear sense of purpose to win in the future is a big focus. And I think that's what it takes to kind of survive through this, right? And a lot of the existing carriers, we need to almost rethink the future and to make sure we pursue this digital transformation that I mentioned and take that seriously. Because otherwise you're going to get left behind and you're going to be taken over. I think that's the reality.
I'm going to add on to maybe this part of the conversation. Alan, you obviously mentioned about the risk side, right, a little bit earlier, which is it takes time for, let's say, a startup like John's, in this case, to collect all the data. But John, at the same point, you've actually early on in the conversation said, hey, we're very much focused on pricing. We have this publicly available set of data that help us understand pricing, and pricing is a big component about risk, obviously. So maybe, John, you can dive a little bit in how you're thinking about pricing and risk. And love to have a little bit of conversation there with experts.
Yeah, I think that's a great question. And I think that, Alan, you are correct. And that has been a key learning from the V1 of the VC-backed insurtechs in auto. And that is when you develop your actuarial models and when your predictive capabilities is dependent on customer volume, it will take you a long time to grow. The way we very strategically bicep that, and this is credit to my co-founder, whom is our head of product, we're building our models based on population size data. So we have over 100 million car crashes in our database going back 15 years, operationalized across 27 states. A typical carrier underwrites off of 40,000 crashes in the state of Texas in the year. We collect 50,000 crashes in the state of Texas per month. And that's just the state of Texas alone. We have every single police reported crash timestamped when it happened, the day. We geospatially map these crashes so we know where they occur. We attach them to a particular road segment. We're able to determine time of day, lane, what was the particular traffic volume at the particular time of the incident, and was it a steep curve, was it a blind turn, and so on. And we have this data available to us that we've operationalized and all at scale. So when you can develop a data strategy that allows you to compute your assessments from population size sample statistics, then you are far less dependent on the scale of the particular. What we then are able to do is we have a baseline assumption about risk in your particular area from the day that you join Loop. And what you will see with other carriers, they'll do like a test drive. That's because they're dependent on your telematics to price you. So you have to drive for 2 weeks before they're able to develop an assessment of your risk profile. When you join Loop, we already know day one. And what we're able to do is within 30 days of you joining Loop, we can calibrate your risk profile against our initial assessment, give you, by the way, opportunities to improve your driving behavior on the road. Let's explore this. When you're driving, a typical telematics enabled carrier is collecting and giving back to you the amount of times that you sped, hard broke, and all this other stuff, which I believe is ridiculously unuseful. Those are the inputs. Those are not the outputs for a consumer. You don't think in terms of like how many times you sped or hard broke. What you think about is like, man, am I being safe on the road? Or, things that are relevant to your particular, to your circumstance. So what we're able to do as a result of having this very robust data set is not only price you accurately, we're also able to take your driving behavior, contextualize it against the road, and deliver safety insights back to you. So Loop is hardly an insurer. We're a driver's companion tool. We see Loop, we see insurance as a vehicle to deploy empathy at scale. What if when you're driving, we say, hey, you're spending, a lot of time on this road, it's a little dangerous. Here's a time comparable route that is significantly less, risk exposed. And I'm using this language, by the way, because we're an insurance crowd. It's going to be a lot simpler and a lot more consumer friendly. And that is powerful. Now we're equipping our insureds with the insights to drive safer. Safer roads equals safer communities, and safer communities equals increased loss ratio performance, improved loss ratio performance. It's a perfect loop, hence the name. So there's a loop in our communication with our consumer, but there's also a loop in our communities creating safer roads. And so I do think that, Alan, you highlighted that's an Achilles heel for every telematics enabled carrier that we've seen to date. And by the way, before Loop was Loop, my co-founder had developed the technology and attempted to sell this technology B2B to other carriers. And we've actually ingested real time, claims data and actual, telematics data to develop these models. So these models are tried and tested and so on. But we've been able to actually see that you can have two drivers on the road, both drive 500 minutes in a month or miles in a month, let's say, and a telematics carrier will rate those 500 minutes equally. But when you're able to contextualize it against the roads, you can see that driver A spends 60% of their time on really crash exposed roads, and then driver B doesn't. You should not rate those two the same. You should not treat those two risks the same, and so on. So that's just a little bit about, as you can see, we get very excited about this.
No, John.
No.
Let me say, John, that's very, very impressive. I mean, if you figured out the loss experience, incredible. I mean, I actually have a similar historical background where I did something similar with people data, and so I hear you, and that's great. And one like incredible idea with the police crash reports. It's semi-public information. One thing that I'm going to say that's and very important in this industry with third-party data is what I call the entity resolution problem, right? So you get all this police report data, you sort of do natural language processing to extract the entities like the automobile, the individual, the roads that were involved and things like this, and then you need to take that data and attach it to something else that has maybe the risk characteristics, and that is enormously difficult very often. And so something that myself and our head of data engineering have built algorithms to support this. But there seems to be, and I was thinking like, absolutely, those police crash reports, if you sold that to other carriers, so valuable. But the entity resolution problem, sort of aggregating information on automobiles, on properties to sort of better understand risk, is going to be a very big problem in the future.
What'd you call that? Entity resolution problem?
Yeah, that's what we call it. Yeah.
Cool. I'm like semi-new to InsurTech, so I'm still learning the lingo, and it's helpful to be on these.
Love it. One thing that I'm going to slightly change just the topic just a little bit here is, early on in the conversation, I think for folks maybe in this audience, they know already, but insurance, especially given the regulations in insurance, are unique to the industry versus some others, right? And I thought maybe Nancy, given how long MetLife has actually been in this process, think about it, can you help us understand a little bit what the implications of maybe AI and that regulation, where these two comes from your position as a larger carrier?
So from a regulation standpoint, I mean, a lot of it is state regulated, but I think when I think about some of the hurdles with some of these laws, I think it's a lot to do with the data privacy laws. So, the EU's GDPR, the California Consumer Privacy Act, right? And then there's, some specific rules within the New York DFS as well. So I think a lot of the big carriers are navigating through this, because at the end of the day, if our goal is to be able to know our customers better, right, as a key differentiator in order for us to deliver that remarkable experience, to offer them the right coverage, the question is, well, how can you do that well? And how can you have a 360 view of the customer if you can't really share the data across the organization globally? And navigate through that, right? So it's a real limitation. I think the ways that we think about that is, at the end of the day, is making sure you catalog where the data is. I mean, it's really around data governance and management, and making sure who has access to it, right? And make sure that when you need to wipe that data, you can find it and you can kind of just delete that. So data lineage is also really crucial in making sure that when you're dealing with customer data, these laws and regulations are really real, because if you do have a data breach, you're going to get fined, right? And therefore, what comes out of that is reputation damage, and that is very, very costly, right? And no one wants to be in that situation.
Does that mean, like, one way I could interpret that is, we talked earlier, as a carrier, you have scale, right? You even Alan, obviously, insurance side, you probably even have even more scale to some degree with the data that you're getting. So even with that scale of data, you're actually, perhaps one could argue, more hampered with the regulation to be able to share that and easily view that across the board versus maybe someone smaller who has a smaller section of data but can be very niche and targeted, like in John's case. How do you view that?
Yeah, I think that's right. I mean, for big carriers to have such a diverse product line, right, and with that global reach in different markets, um, it's hard. And I think if you're a smaller insurance company that just specializes in auto and home, like your scope is just a lot more focused. So the complexity with just again the product mix, the market size, the customer base, I think that's really the biggest struggle when you think about the regulations that ask you to manage your data responsibly, right? And sharing that in a responsible way.
And John, in your view, as you're going to Texas, right? You probably have to go through the filing process and all of that. How do you view it differently? Do you kind of just go, we've got it handled. We're just focused on one state. We'll do the next one as we grow. Or how do you think about it?
First of all, shout out to any regulators who may be listening, just to acknowledge them and so on. No, I think regulators play obviously a very, very important role in consumer protection, and of course their focus over indexes on ensuring that new methodologies introduced are not disproportionately discriminating against vulnerable groups. Specifically African American and Hispanic American communities. And so, for example, in the world of telematics, which is my niche world at the moment, it's the fastest growing segment. Usage-based insurance is the fastest growing segment of private passenger auto. Will make up about 30% of the total, making up 30% of the total products sold to date, and growing 25% compounded annual growth rate year over year. And COVID, of course, shifted fundamental driving behavior. So it's growing. But now, in the world of telematics, for example, let's discuss a methodology that its growth was effectively slowed by the regulatory process as a result of its outcome. And that is pay per mile. Okay. Metro Mile and a bunch of these other pay per mile players introduce this concept where you pay by the mile. Okay. Well, not only is it problematic from a business perspective, because then you're insuring someone and only collecting a fraction of the revenues because they're not driving a whole lot. And then two, it's a very niche customer. But three, from the regulator's perspective, this disproportionately discriminates against typically lower income communities who have longer commuting threshold and distances to get to work. And so now your methodology inherently is penalizing someone who has to commute a longer distance. Because if you're pricing based on distance and someone whom is, from a socioeconomic perspective, less able to afford living right in the downtown, then you're driving longer distances, which means you're being charged more. And so this is a perfect example of how, if you're not calculated and thoughtful in the way that you're developing your models, you will run into the regulators and they will slow you. And guess what? They should, because you aren't thoughtful in your approach. Now let's explore loops. And by the way, if I sound smart, then all credit goes to my co-founder, Carrie Ann Nadeau, whom conceived the data strategy and the product from inception. I only am just a quick learner and have very sharp business acumen. So I'm able to take the data, the AI implications at a high level and discern from it, business outcomes. But from the Loop perspective, the way we were able to bicep that as an example is and she's an MIT alum, by the way. So shout out MIT. But our methodology effectively removes credit, which increases the amount of discounts going towards typically lower income communities. And so that's just a low-hanging fruit way example that we were able to align ourselves with the interests of the regulators. I think that the takeaway there is, if you're looking to innovate in insurance, you must align yourself with the sentiment and the purpose and the North Star of the regulators. It will increase your probability and rate of approval, and thus will enable you to expand much more quickly and unlock market cap and capture market share and grow your business.
Got it. I have to say, having also worked in insurtech, that's the first time in the startup scenario where I've heard someone say the regulator should stop you. So I'm going to chime in myself in many cases and actually even argue in some cases, I think regulators themselves are just getting to learn through some of the processes and some of the changes here. So it's interesting to hear someone on that side. But I don't know the regulation on the reinsurance side very well or at all, Alan. I was curious if that's a challenge even for you, or perhaps that's something that you put it on the burdens of the carriers and insurtechs themselves to go figure that out.
Well, so as a sort of in the reinsurance brokerage world, we sit in between the carriers and the reinsurers. And I can say the reinsurers have it's amazing. They have very little regulation, and it's on purpose. Like if an insurance company goes under, it's sort of a too big to fail situation. You want to protect the consumer. Or if a reinsurance company goes under, it's investors who suffer. Well, it's just fine, right? So we sort of advise on both sides as much as we can. But it's funny. I remember when I just joined the industry, someone invited me to the NAIC NAIC meeting, and I was like, "What is this all about? Who cares?" It's like, "Don't you understand how important these people are, especially for data?" I'm like, and it's a very big deal. They have each sort of state has their own set of regulations and what you can and cannot do with data, and they're learning with the insurance companies on a monthly basis. I remember, I think it was in New York. It was super exciting. They were talking about setting up data science sandboxes to test machine learning algorithms, and I was, really? That's a big deal? So it's a journey that everyone sort of has to take together, I think.
Got it. I mean, I think there was recent regulation, at least in New York. I don't know if MetLife or Nancy, you saw that as well, where I think there was new regulations about how the explainability, if you were using models and what that means as an example, as part of your underwriting process. Although I think the wording was much more broad and a bit vague in what that can be done. So I think, at least from my limited experience, there's been learning along the way on both sides how to work on that.
Yeah, I mean, I think we're all just trying to learn as we go too, right? So in this whole spirit of experimenting and failing fast, I feel like everyone is in the spirit of, there's a lot to figure out together. And I think there are definitely opportunities where, people are participating and commenting, right? Some of these rules and regulation is like, what's the impact if we're asking these carriers or companies to operate a bit differently? So yeah, I think in all together is also a bit of that, aspect and how we think about the regulations and we'll put together to navigate through that too.
At this point, I'm going to just encourage audience members, if there have any questions along to any of the panelists here, please do enter that in chat. We do have one question. I'm going to shorten a bit of the comment into a question and maybe just open it up for a general discussion. The question is, has anyone here worked in the industry looked at obviously insurance for maybe a risk comparison as part of our solution solving climate change? One can make the argument that insurance and thinking about driving by mileage obviously can be a factor in doing that, but I'm curious if that's something any of the panelists even worked on or remotely touched upon.
Yeah, I can say from our side here at Loop, we believe that private passenger auto carriers have the biggest immediate financial interest in climate change. It's the stakeholder that en masse is from my perspective, the stakeholder that en masse has the biggest aggregate amount of drivers on the road that are contributing to, of course, environmental factors. And so I do think that there is a play there in insurance to incentivize the use and adoption of electric vehicles. So for example, at Loop, we worked into our actual rate filing, which of course is the way that you price your consumers. That has to be submitted into regulators and then approved, and then of course your rates are locked. And so therefore you have to be thoughtful about what it is that you submit, because that's kind of like the DNA from which you're building the architecture of the product. And one of the rate factors that we worked in there was an electric vehicle discount. We thought that let's be responsible here and encourage the adoption of vehicles that have a net neutral or at least less of, in the case of a hybrid, carbon footprint. And not only is that the right thing to do, but it's also a wonderful consumer sentiment to align yourself with. And also there's data out there that suggests that drivers of electric vehicles are typically involved in less accidents. So it's profitable all the way around. And I really feel like now, of course, if Loop scales, we'll be at 100 million premium, 100 million written premium in a few years. But what happens if Geico does something like this, that has billions of premiums in force and can really move the needle in a big way? And so I do think that insurance, particularly auto, of course, is contributing and can potentially influence the carbon footprint as a whole in a meaningful way. And it just requires thoughtfulness around how you're incentivizing folks to adopt electric vehicles.
So, totally different way of coming at this. Climate change is a big thing in reinsurance. Reinsurance is getting much more expensive as a consequence of climate change. So thinking about wildfires, hurricanes. So, if you look at a carrier, a traditional insurance company, it's the law of big numbers, right? That I have all of this actuarial experience, pipes bursting, trees falling down in homes, and I just add that all up and I just, sort of build the strategy and I go to market. I don't always pay attention to where, the accumulation in my portfolio, one policy at a time, right? But you might be getting an entire area in Florida that gets hit by one big hurricane and you're done as a company, right? And that's where reinsurance comes in, is we have that correlation risk. We run catastrophe simulations all the time for this sort of thing, and we have to include climate change in those models. And as a consequence, reinsurance is getting much more expensive, but not necessarily always at the individual sort of policy level that consumers are experiencing. And so it's we're going to see those changes over time, but it's something that I'm very excited about, because I think there's an opportunity to sort of bring climate change APIs that we provide the data to the insurers so they can incorporate it in underwriting and pricing. But that's much future looking.
That's fascinating.
That's fascinating. I didn't know that carriers have to start thinking about the cost in that way. I would never have thought we would think about that.
Yeah.
Another question, I think, from Edward, and again, any of the panelists who want to jump in, maybe, what percentage of losses are due to fraud? Is fraud losses a thing in any of the industries that you're working on, and is that something that you're thinking about already? Anyone want to jump in on that one?
Yeah, I mean, I could take that. I mean, I don't have the actual statistic in terms of, the fraud losses in the industry, but I think in our space here, we've actually been using AI to actually flag claims that come in real time, and being able to, queue them up and say, hey, this claim coming in actually looks potentially fraudulent. And really making sure that we're not paying fraudulent claims, right? Which is something that do happen today. It's just hard to detect. But the use of AI and using vendors that are specialized in the fraud AI space actually has been quite helpful for us. And we've actually done that in Japan quite successfully. It's definitely reduced the fraud metrics, and we're hoping to scale that as well. So we're seeing some real promises in how AI can really help curb fraudulent claims in the insurance space.
Alan and John, is that, I don't know if that's something also.
Yeah, coming into this business, I really grossly underestimated the real risk and threat that is fraud. It sounds like it's not super common, but collectively across all lines of insurance, it amounts to about $80 billion a year. And specifically within auto, it represents about 14% of all personal auto premiums, which is about $34 billion a year. So it's something that our head of insurance, whom built the carrier from 2 to 20 states and has been in insurance forever, flagged as an important variable to consider when planning out your expansion strategy. And so at Loop, for example, we're going live in the state of Texas, but we're filing rates in the next 10 states right away. Illinois, Ohio, Pennsylvania, Washington, New York. We prioritize states based on a number of different variables, one of which is historic loss ratio performance. We want to be in states that are typically don't run as hot. Another is geographic, or rather hazard types of risks, like Florida is a kind of a tricky market to make money in auto and so on. Regulatory climate is another, and fraud was another. There are states that just have higher concentrations of fraudulent activity, and it amounts to actual losses. Now, that said, I do think that there is an opportunity for AI-driven companies, or even non-AI driven, but vendors that can deploy AI technology, because since it happens at such high frequency, you're able perhaps to develop some detection patterns and alert carriers to when there's some fishy activity and allow you to get in front of things much more quickly. So I think that that's an opportunity. And generally, from a business philosophy perspective, I like to run towards where people are running away from. So I'm not completely discounting markets where there's a lot of fraudulent activity, but as a startup, it's not in our best interest at all to be operating and catching our bearings, as a carrier, dialing operational experience and claims handling infrastructure, and then also having to deal with the wild card that is frauds. So we will get to it, but it most definitely is a real risk that I underestimated as a newcomer, and I encourage other new entrants to take seriously as well.
Yeah, I would back that up. I think that the carriers have enough on their plate. Losses are small, and then if you go into fraud, you're looking at a needle in a haystack problem, and you've got the needle in a haystack across every single carrier. You add up all those needles, you've got a separate company that you should be building to help solve this problem. Like help us label fraud, help us detect it automatically, but in such a way, the sensitivity here is that I think the core asset of every carrier insurance company is its loss information. And, you give that to any one party, it's scary, right? Because they can compete with you if they have all that. So I would say, it's a delicate problem that needs to be solved by, cross insurance company technology in such a way that it doesn't interfere, with the core value proposition.
And maybe Al, just to add, you mentioned obviously you thought the core asset is loss. I mean, you don't think, at least in this case, maybe for carriers directly, it's actually the marketing side or the consumer data or the things of that's important, not as critical as their loss data?
I would say that it's secondary, but very, very important.
Just maybe last, Nancy, John, do you have thoughts? Is that kind of how you think about it as well? I'm curious for those who are more consumer facing. No thought.
No formed opinion. I trust the scale and expertise that comes from reinsurance. Shout out to reinsurers, whom are an incredibly vital stakeholder in the insurance community. And unless you just completely vertically integrate and form your own captive, you're not going to get off the ground without the expertise of reinsurers. And in our case, we're working with a top 3 global reinsurer that just has an incredibly macro perspective. And so many times they come to us with the pulse of the market at a macro level and are able to inform our models and vice versa. But, it's not to say that reinsurers are like the arbiter of truth, but of course it's much like, my days as a VC, you're just developing top down perspective and able to develop semi-informed opinions across a number of industries all at once. So I would trust Alan on this one.
All right. We've got about 5 minutes left, so I'm going to maybe ask each of the panelists here to, as we kind of come to a close here, and if there's any other questions, obviously for the audience members, please do bring up. But maybe if you have any questions, ask maybe each of the panelists to, if you were to give a parting word of advice or just thoughts that you have in this conversation, what might that be? And I'm going to try to do this time maybe in the reverse order. So, Alan, maybe I'll go ask you first. Any thoughts for this conversation here?
Sure. I mean, I would say parting words. Everyone should come work in insurance. I mean, like honestly, it is such a fun space. How am I able to attract talent that would normally go to Google, Amazon, or Facebook and so on? Is that I have to say, those companies are big now. Those are very big companies. They struggle with a lot of challenges. I recall, talking to some of my former colleagues, they would have to wait 2 to 3 months to deploy maybe 3 lines of code in production, right? I mean, 3 months for 3 lines. That's nuts. The opportunity to innovate as a data engineer, a data scientist, or even just a general software developer within these big firms, you have to look for work very often. And in the insurance world, it's all there. It's ready. People are, the phrase I always say is you could trip and fall and by accident create value in insurance if you know data science and data engineering, right? It's a big opportunity. It's a lot of fun. And there's very few, places where you'll find all of these great things where you can sort of mix engineering and math, right, in such a unique way. And so just come to insurance.
And if someone wanted to actually, know if you're hiring and contact you, what's the best way?
We are hiring. Hit me up on LinkedIn. We're growing very quickly, and we're excited to get your resume.
There you go. That's excellent. John, any parting thoughts?
Yeah, I loved your sentiments, Alan. I co-founded Loop July of formally August of 2020. So very newcomer, didn't know anything, didn't know the first thing about insurance. And one thing that you will find is it is an incredibly opaque industry. It is quite difficult to get up to speed on there's resources out there and there's blogs, but to really internalize the information and be able to have informed discussion, you need to be rooted in doing. And that can come in the form of starting your own blog, podcast, host these types of conversations, start your own InsurTech or join an organization. But I will say, now I'm deploying rate filings and actuarial models and all kinds of stuff, and you can really get up to speed quite quickly. So I would say to folks that are on the outskirts making their way in is don't be afraid to ask the rookie questions and find a few people that you feel comfortable sounding novice aloud of. And, by the way, as a former investor who looked at quite a number of financial models and so forth, the insurance balance sheet is very distinguished. It's very distinct. It's a performance-based model. It's not going to look like any other type of balance sheet. And of course, that is kind of like the grandpappy of documents that then influences all different facets of the organization. And so I say that to say that the insurance business is very unique. And I think that as a result, there are a lot of specific nuances that make all the world of difference in the insurance business that you're not going to find in other businesses. Unlike in e-com or, beauty, commerce, and media, the financials are the financials. And once you get adjusted to the multiples and how hot you should run and what the gross margins are, you got that business more or less figured out. And then it comes down to expertise on the creative variables. With insurance, there's a lot of time that has to be invested up front to get accustomed to the mechanics, how it all works, the stakeholders. And there ain't a lot of people that's going to give you that information because they can't be bothered. They're busy and or they get a lot of requests. So I do just want to give a shout out to MIT for hosting these discussions. I think they're incredibly valuable to the ecosystem. And yeah, I guess the takeaway there is dive in head first, ask the rookie questions, get up to speed. And if you can, join an organization. And so I guess the last plug is we're hiring at Loop. So we just brought on our products and compliance specialists. We're looking for a customer service manager, an underwriter, and an actuary. And 100% of staff members at Loop, from the call center up to the CEO, get equity in the business. So come join a team that is changing the game. Yeah, you can hit me up directly on LinkedIn as well, John Henry.
Awesome, John. And good luck on launching in Texas. So Nancy, maybe last but not least, obviously you.
Yeah, I'll make this brief. I mean, I really enjoyed today's panel. Thank you all so much for including me. I think my parting words would be, insurance is actually a great time where people should join, because it is going through significant transformation, and the whole aspect. So if you're interested to help reimagine what the space is going to look like in the future, this is really the industry to really join in. So I think those were my quick, simple parting words. It's a great place to really, share your talent and really help drive that transformation in what the industry needs.
Yeah, if anyone wants to reach out to you, any preferences on how they might contact you?
Yeah, I mean, LinkedIn is a great place to hook up on with me and Nancy Hom. So search up and then we'll get connected.
Perfect. Well, with that, I want to take you're on mute, John.
I just want to give credit to you, Shaw, for being an excellent moderator. I've done a number of panels, as I'm sure we all have, and you rarely find someone that knows how to flow from conversation and doesn't always keep it in the same order and allows the conversation to build when it's building. So I think you're naturally very talented at this, and I
appreciate it. Thanks very much for all of you taking the time, and thanks for all the folks who were able to join. It's been a great session. I've learned a lot. Hope you've learned something too. And obviously, thanks to MIT Enterprise Forum New York City for hosting this. And with that, I'll close and hope to see everybody else online.
Thank you.